Okay, so today we're going to be going over inducements and basically the model that we're focusing on. So, first of all, just to get this down first, what is an inducement? Right? Let's just get the proper definition from Google quickly. Inducement. So, there it is. Okay, so what is an inducement? A thing that persuades or influences someone to do something. So, when is an inducement used? Inducements are used when the market doesn't have sufficient, how I spell it? Yeah, there we go, sufficient liquidity. So we all know that if the market doesn't have enough liquidity, then it will engineer it. In other words, we will induce people into the market to trick them that it's going one way and then obviously run the other way. So if we understand that, there's multiple different type of inducements, right? People that want to, right? They think we're going to go long off like a smart money trap, and we end up selling off. You got like trend line liquidity, order flow, whatever you want to call it, inducing, right? Sell off. Bunch of different ways we can do it. Now, for our model specifically, that's what we want to be going over. Inducement highs, let's type in inducement high, low model. Move these over. Okay, so the inducement high and low model. It's like I feel like the best way to go over it is I'll draw it out and we can kind of just like probably label points, right? So we got a run up, pull back, and then we get another high printed running some sort of liquidity on the left hand side. So we can do something like this. Perfect. Okay, so this drawing right here, this could have multiple models within it, right? You have liquidity swept over here, and let's just say, for example purposes, we had something like this. You can see that sellers are induced right here. So let's just bring this up a little bit. There we go. So sellers are induced right there. So now that sellers are induced, the market gives the reaction, right? Now we get a low printed in the market. Now this low, as soon as it rallies up, takes out this high and also clears this high here on the left where the selling pressure basically started from. Now we have the model forming. As soon as we get this run up from A, from this leg, from this low to this high, that's basically where the trap move occurs. Now, when that happens, basically where the start of the trap move occurs, where the start of this liquidity run occurs, this is now known as the inducement low. Why is it the inducement low? It's because this is where sellers were induced and price. You can kind of call this like this whole leg right here, this whole bearish leg. You can kind of call it like your inducement leg, you can say, because sellers were induced at this point and it pushed price to this low. And then that after this point, we got that trap move to the upside, clearing A and B. Now we know this as our inducement low, and this should get taken out when we start selling off. Okay, so you can see that we get a reaction. Let's just say some sort of mitigation happened to the left over here, and then we get a nice sell-off, and then the market purposely reacts off this false buying area, this false order block, this false whatever you want to call it, right? So now, if we have the understanding that price needs to take out this low here, so we'll mark this as our inducement low. If we now know that's our inducement low and it should get taken out we know that we can keep shorting into this low. So let's just say, for example purposes, this diagram is a like H1 time frame. You can trade this bullish A to B. That makes complete sense. If you have the understanding that we need to engineer liquidity over here first before we can continue pushing down, then that makes complete sense to be looking for buys in this area, because basically this area will provide us false reactions, but it's only going to provide us another opportunity to keep selling into the liquidity below the inducement low. Okay, so if we understand this inducement low, again, we want to be selling into it. Short-term buys could happen from here, no problem, up into here, and then after, we want to be looking again for continuing or continuations to the downside. Another mitigation happens. Now, look at this on the flip side. So now that we have an inducement low model being provided to us so we can short into it, now look what happens here. If we understand that this area is a trap and buyers are going to get induced into the market, this right here, we can now kind of label this. This is like your inducement leg. That's what we'll start calling it, kind of. This is your inducement leg, A to B. Now what happens is, after buyers are induced, we set that high in the market. We set that high in the market, and we get that inducement high. Inducement high. Let's move this over. Oops. So there's your inducement high. Now, if we understand that's an inducement high, we can buy into this. So you can see that early buyers get swept. We get some sort of mitigation here. We get some sort of mitigation at the lows after the early buyers are swept below the inducement low. Now what we can do is look for buys all the way into this inducement high at the least. Then who knows? I mean, it all depends on the higher time frames, but maybe there could be a mitigation here and we can continue selling off. Or if this was overall a higher time frame, maybe that high is going to get taken out and we're going to continue pushing. But it all matters. It all depends on what like the higher time frames are saying. But we could also see a mitigation, continue selling off, like I said, or there could be some sort of reaction, give us a pullback and a continuation to the upside, either or. But that's not the purpose of this. The purpose is to focus on why this is an inducement low and why this is an inducement high, right? So after we get this low printed here, after we get this low printed in the market here, now price action is just not always, but there's gonna be different variations of how we're gonna push back up to the inducement high. Sometimes we can get price to do this, right? It'll just continuously give us clean order flow all the way back up to the high and then maybe blast through it. That happens a lot of the time. Or sometimes it's very quick. Like we get the sell off. We get the sell off from here and it's quick, maybe gives us a reaction, pull back, and it continues up. So it all depends. That's why after the inducement low is taken out, the liquidity swept, and we see that mitigation, we can manage and monitor the lower time frames and look for some sort of price action that we can like to go back up. So for example, if we get, so we'll basically pretend this is like the higher time frames here, this bit of price action at the below the inducement low where the liquidity swept, and I'll draw out like maybe a possible play that the lower time frames are giving us. So we sell off here. Let's say we get something like this, false reaction. Then we get a trap move to the downside. Maybe something like that. Boom, boom, boom. Okay, so let's go over this. So this is your inducement low that we were talking about up here, right? So what happens is buyers were induced. So that'd end up being above this low, right? Buyers were induced somewhere over here. Buyers were induced. And then we get that trap move to the downside. Price pulls up. Engineers liquidity at the highs. Induces sellers into the market. Now that we induce sellers, what's that low? As soon as we clear this liquidity, what's that low now called? This is now your inducement low. Same model, just being given to us on a maybe a little different of a variation, and also lower time frames. So there's your inducement low. As soon as the market runs that inducement low, you can see maybe some sort of mitigation happens down here, and there's a solid buying opportunity. As soon as we pierce through that inducement low, buy happens here, stop below, and where can we target? Whatever it is, maybe up here, target liquidity. But yeah, so I hope you guys enjoyed this little lesson, I guess you could say, on inducements and our model. But yeah, it is. It's actually it is quite an easy model to understand. I know maybe it's a little confusing at the beginning, but I promise you, the more you practice this model, this plays out. It's fractal, right? It plays out on every single time frame, and that's why it's so deadly. So yeah, I hope you guys enjoyed, and feel free to message me if you guys do have any questions about this lesson specifically.